Huge disparity between the S&P and Nasdaq. Nasdaq's breaking out. S&P is in the middle of its trading range. We're going to talk about why and what this means for the market. This one indicator going back 100 years has predicted what the market is going to do 100% of the time. We're going to address what it is and how we can utilize it. Number one sector breaking out today and what exactly it's telling us. After hours, there was news on two major regional banks. We're going to discuss the news and what it means for tomorrow. We need to address this massive sell-off at the end of the day and why the reason it happened and what we can expect out of tomorrow. There's a lot to go over, so let's jump right into it. Hey everybody, welcome back. So today we're going to go through a lot of detail on the earnings that have come out and are expected to come out this week. It's very important. I do want to go through a couple larger graphs about what's going on out there with a larger time frame, but we should just probably start with the absolute basics. Now, if we come here and just draw the line straight across, we can see 4180 continues to be respected. And it's somewhat troubling if we start to look in here. You're getting to this point right in this section where you very simply, you just can't break above it. And that's really becoming an issue. It's something that we need to address. Now, more important than that is why are we able to get over this 4150 level? If we drill into this on an hourly and we just start looking at what's happening here, well, we are consistently being walked down, right? And we can all see that, but if you see that, that usually leads to this, right? Some kind of selling, and I don't know how bad it's going to get, but this is not warm and fuzzy, this lower highs, right? And we can all see that. So that's not something that we're going to like. I don't like DTLs like this for this long. I'd like to see them break out. Now, I don't really mind that the S&P is going down as long as the Nasdaq continues to go up. We want the Nasdaq to be the leader. We've been talking about this for some time. That's very important. Now, we can go back and take a look at some of these levels, and I think it would behoove us to do that. So let's drop this right here in the middle. And what I want to do is just show these key levels and how we're acting at them. So right here, this 1335, this was a key level, something that we really should be focused on, this 1335 right there. And then what we're noticing is they keep stepping up the level, right? So before this level, you can see these resistances right in here. We're just going to drop that right around that 13. And you can see how that was resistance in this area and how that flipped to support, right? Comes back. And then you have your little retests in there on some other areas. And it's important just to note and monitor those and just see how those battles played out. And you can see how we flipped, and then you have these retests. These retests that you see in here are so important to see that you come back and retest that area. I can't stress that enough. So if you see how we come down here and we did the same exact thing, right? We did that retest right there. That's what you want to see out of everything. So here we are coming across. You're seeing your retests. And now what we're doing is they stepped us up once again. We know that this 13.5 was our key level. We watched that level and we went over it in the pre-market live. If you don't, I suggest that you watch our daily pre-market lives. We give a lot of key levels and it's definitely something to pay attention to. So if we see this, I think that this is somewhat interesting. I'm going to use a couple different pointers tonight. Let me know which one you like. So we could see these lines right in here and they're extremely important, right? You always want to make sure that you're doing this. You want to make sure that there's a retest. And once there's that retest, you want to see if you're going to hold. Now, I don't know if you hold tomorrow or not, but that's definitely something that we're going to want to watch and pay attention to. Now, this is probably one of the most important graphs that nobody's paying attention to. This is the Nasdaq relative to the SPY, and what it shows is outperformance. And that's exactly what you want. You want outperformance. You want the Nasdaq to outperform. Now, we've gone over this ad nauseum, and we've shown this neckline that's been in here all the way back since the pandemic and how the Nasdaq has outperformed, right? And then slowed down and outperformed. And then you had a period here of about a year and a half where all you really did was you didn't really outperform. You just kind of went sideways, right? You didn't really go anywhere. You just kind of stayed in there. And then as time went along, what happened? Well, then you started getting into these positions where you start retesting that level, you're unable to break it, and I think that's somewhat important. And then you just start hitting lower lows, and as we hit lower lows, I think that we just need to be aware of that and say, okay, well, why? Why were we hitting lower lows? Well, we were hitting lower lows because the Nasdaq was going down faster than the S&P was going down, relative performance. But this is a key barrier to the Nasdaq's outperformance, and we're flipping it, and that's pretty substantial. That is not something to to pretend it's not happening. As a matter of fact, if you look at relative performance of the Nasdaq since 2023, we're at highs on the year. So this is not something that just changes momentum and goes away. This takes a lot of money for this to do. And so that would tell me that I should expect, especially since you pulled back and broke out, we should expect the Nasdaq to continue to outperform. Now, that could just mean it doesn't go down as much as the S&P. It doesn't mean that it's going to break out. But we need to pay attention to this, and we're seeing some other signs as to why this might be. To start with, the number one sector today was computer hardware. And I thought this was kind of interesting, and I'll explain why, but I'm sure everybody can see this flag and that break right there. Now, I mean, it's pretty glaring, but we'll just put the square around there so that you can see it and focus on it. So you can see that flag and you can see that breakout. That's pretty powerful. Now, what I did here was to try to fit everything in the screen, I put the names of what this index, it's a sub-industry through MarketSmith. And this way you can actually see the names that are in the index in case you want to go through them yourself. But if you take a look at how this is playing out, I think this is pretty significant, that we are breaking out. Well, why would computer hardware stocks be breaking out now? These should only be breaking out if we're dealing with CapEx. If we're not dealing with CapEx, these should not be breaking out. So this is interesting, and we need to understand why this is happening. So we see the outperformance, right? If you connect the dots, Nasdaq's going higher. We're getting that outperformance, right? And the S&P is going sideways, and we're going to talk about why that is. But what's going on that's driving this? What's happening? Well, we're starting to see breakout, and we're starting to see breakouts in the AI space. And what's predicted is that AI is going to increase margins and profitability of some companies. Watch this 2333 level to start. It's actually a little bit higher. I'd be more interested in this part right over here, but start with 123.33 as a key level. Now, one of the reasons why I'm bringing this up is we need to really pay attention to what's happening here. Why is this going higher? Why is this breaking out? Well, AI, 15 different AI products they came out with, okay? Microsoft, start looking at Microsoft. Well, Microsoft hit a new high today. Now, maybe we didn't close at that new high, and we're going to address why the market sold off. There's two reasons the market sold off, and we're going to address both of them in a moment here. But when we start looking at this, right, and we just look and go, okay, well, this is from earnings. And since earnings, what have we done, right? Let's just take a look at that and get the hang of these things. And just look at that particular section, right? What is that telling us? Well, that's telling us that we broke out, formed a flag, and then we tried to break out the flag, 1, 2, 3, and we're just not able to do it yet. But we did hit a higher high, and that is something that we need to pay attention to. Now, I think a lot of the sell-off had to do with the debt limit and some of the issues going on there. I'm not going to spend a ton of time on the debt limit because a lot of it's posturing, and when it comes down to the fact that they're not going to be able to cash Social Security checks for their constituents, the gamesmanship ends, and it's always been that way. So when you can't cut the Social Security checks, that's pretty much the end of it. So that's why I don't put a lot of value in these. Let's put a line here so that you can see this come straight across and look at that support level. And what we saw here is what we've been seeing all along, right? See how you just dropped off down here? Well, this drop off and what's going on there, right? Why is that happening? Well, that's happening because they're selling down ahead of earnings and then they're popping. And you're seeing that in every kind of name. It's not one name that's doing that. You're seeing that a lot, that particular pattern. The reason I'm bringing this up is what's driving the computer hardware space is the premise that AI is going to increase gross margins, therefore profitability, therefore productivity is going to go up. Now, if that's the case, this makes a lot of sense. Google, Microsoft, but you're starting to see other sectors break out as well. So if we take a look at the stocks, well, yesterday, just a caveat, I have a bunch of semiconductor trades on and I own SOXL. And I see the rally and now we have the gravestone and maybe we're going to break the gravestone and come back down. I don't know what happens. All I know is we moved higher, and I know there were two reasons why we sold off today. One was the debt limit and the fact that he's moving the G7 to cut it short to come back and deal with debt talks. So if you take a look here at that breakout coming across, well, yesterday's action was not NVIDIA, it was not AMD, it was the three horsemen. And if you don't get the newsletter, I'd strongly suggest that you get it. I put these out in the newsletter, and so you could have followed along with them. But Newsletter's free, link in description. But you see that break coming straight across there. That's definitely something that you could pay attention to. It's something that I would be paying attention to. And this AMAT and how these are acting, all of them rallied, right? All of them rallied, all of them pushed, and then gave it back today. We're going to discuss why they all gave it back. But if we take a look at that, that's important. So we have that move, and then you go and take a look at NVIDIA, and you realize, well, NVIDIA did not hit a higher high yesterday, but it turned, right? So once we turned yesterday, that was it. It moved. Now, if you get into NVIDIA and you get into AMD, you hit higher highs. So no matter how you look at the day, no matter how you want to judge the day, AI is powering, and it is going into these particular chips. And now you're seeing the equipment manufacturer names start to move. AMAT has earnings on Thursday. Everyone's going to be looking at their backlog. Okay, that's the next move. Everyone's going to look at their backlog because there's a lot going on there and we need to pay attention to it. If the backlog is huge, these names could just really rally pretty significantly, much more significantly than they have. So that's why we're seeing that breakout. Now, we understand what's going on with semiconductors. We see the move. Why did we sell down at the end of the day? Debt limit, and on top of the debt limit, more importantly, it was Home Depot's numbers. Now, Home Depot is a mixture of retail, and that mixture is really something that powers us, right? They are trying to sell electronics. You go in there, you buy your grill, you have your contractors. People link it to housing, and it should be because they have more contractors than Lowe's, but they sell everything. So when this sells down, which is exactly what it did today, we saw pressure on the market. Now, this pressure led us to believe, and we're already seeing calls on this, you saw a lot of investment banks today saying Target's going to have a bad quarter based upon what we're seeing out there. And that kind of makes sense, actually, because if you take a look at the Michigan consumer sentiment, you'll remember this and how we came in. I'm going to go out to the weekly on this. But you remember we looked at this on Saturday and we went back to the 50s. And the last reading that just came out that's not even in the chart yet was 57. And that puts us right here. So consumer sentiment was down. Retail sales came in at 0.4 today. And that is obviously lower than we were expecting. So it was somewhat of a double whammy for XLY today. As soon as Home Depot was weak, that was not great. And then you had retail sales coming in at 0.4 versus that 0.8 that we were looking for. And that just added to weakness. So that leads us into Target, which is the second reason that we sold down today. We got to the point where people were getting a little skittish. They don't know what Target's going to do. And if you take a look at Target, I don't think Target knows what it's going to do. Now, again, you're seeing some pretty bearish calls out there ahead of this. I'm just going to drop that right here in the middle. But you can see Target the one time, and this was a year ago, but consumer sentiment's bad. Retail sales are down. Home Depot just missed. So that's not going to make somebody warm and fuzzy and saying, you know what, I really better long Target into earnings. Then you have Walmart. Now, I actually think this presents an opportunity if Target cracks, because the goal is when Target cracks, you buy Walmart. That's somewhat of the play because they're different clientele. So if you take a look at this and you can see the levels and you just go, okay, well, here we are. Well, we had earnings and then we fell down. Well, we had earnings and then we fell down. Well, we had decent earnings and we still kind of came down a little bit. So there's not a lot of faith right now in Target. I don't have a lot of faith in a stock when you're like this and you can't get above the 200 ahead of earnings. But what have we been seeing happen? We've been seeing them not rally us. We've been seeing us not rally. And then what are we doing? Then we're rallying and we're gapping up. So I think that you just saw profit taking today, but there is no way that you can be looking at NVIDIA right now and saying, oh, well, I'm going to call the high. Well, if you didn't call the bottom, do yourself a favor. Don't try and call the high, right? Don't do it. It's very difficult to say that AI is miraculously going to stop, or you're going to talk about valuation. Stocks move on supply and demand. They don't move on valuation. Valuation may change, and that valuation may affect why someone's buying or selling a stock. But if there's demand there, it doesn't really matter. And right now, people are looking at AI as the next gold rush. Whether or not it is remains to be seen. You're going to see that with AMD, NVIDIA, Google. Get used to this. This theme is not going to go away. You saw today where I think it was Ackman came out and put $10 or $12 billion in Google. Frankly, it makes a lot of sense. Google did not move on AI at all, and now it's hardly moved. Now, people are going to say, well, that's a big move. That's minuscule compared to the move that a lot of these AI companies have had. And it's people coming out now and saying Google's ahead of Microsoft. So how this plays out remains to be seen. I watched the Intel AMD battle in the 90s play out for a decade. Now, I read this report. Let me be really clear. This is not my report. This is from someone at Sediment Trader that is an analyst there. They do pretty good research. I always find things like this interesting. So what they're saying is when you have this, and let's explain what this is. This is the S&P above. Percentage of sub-industry groups with a positive 1-year rolling return. Percentage of sub-industry groups. So think of the 197 industry groups that someone like MarketSmith has, for example, with a positive 1-year rolling return. Well, we've gone from the red line to the green line. Now, this is Sediment Trader's analysis. Sub-industry signals with a perfect record since 1942, meaning it has not missed since 1942, which is kind of interesting. And what they're saying is the percentage of sub-industry groups with a positive 1-year rolling return cycled from minus 20%, meaning you're at that 20%, less than 20% of sub-industry groups, or have a 1-year rolling return, right? That's exactly, just remember this. This is what it's stating right here. It has to have a positive return cycled. And what they're saying is when you're less than and you go to 50%, okay, it's happened 26 times in about, let's call it 90 years, but close to 100, right? So you've happened 26 times. After similar reversals, the S&P has had a 100% win rate since 1942. Now, what this article does not do is tell you about the percentage move when this happens. But when you have something with that kind of win rate, you want to pay attention to it, and you can screenshot this and go and mark it off yourself. I always tend to look at these things before I even post them. And I did look, and it's pretty impressive what this is telling you. Marked 09, marked the pandemic. I mean, it marked a lot of things. Obviously, I'm old, but I'm not this old, so I don't remember the 40s and the 50s. But I can go back here and tell you right here that obviously marked the low of what we thought was going to be a real issue when we went into war with Desert Storm. So when I look at this, it does equate to something, and it does make a little bit of sense. And it does also fly in the face of what we've been saying where, well, the breadth is bad. Well, if the percentage of sub-industries, right, if they're going up and the positive 1-year rolling return of those is going up, how bad is the breadth, right? Maybe we're just looking at it the wrong way and we should be looking at the sub-industries. Maybe certain sectors just got really ahead of themselves and maybe the breadth is not as bad as we think. Just something to think about. Now, there are 3 names that you must watch tomorrow. Number 1, you must watch Target. You have to see how this plays out with earnings. It's very, very important. This will come out before the market opens. Walmart will move on this. XLY will move on this. Target has the ability to drop Amazon. Okay, people really get into this data. Now, that might not be the worst thing here for us. If it hits Amazon, that might be our way in. Or we might want to wait for Walmart the next day. And don't forget, guys, we have Powell on 11 o'clock on Friday. And who knows how that's going to go, which Powell we're going to get. So just keep that in mind. But tomorrow, pre-market, there's nothing more important than Target and Target sales. People will be glued to this. This is much larger than just Target because it shows traffic. And I'm going to just tell you this, that the retail sales numbers by JP Morgan through their Chase cards was predicted to be significantly higher than it was, and they were already negative on Target. So they're predicting that Target's going to have a really bad quarter. Whether or not it does, it's a coin toss, candidly. You just never know how they're booking revenue, and there's a lot of moving parts to it. But this is one. Number 2, this evening, WAL has come out and said, hey, our deposits are increasing. They are not decreasing. And what you're seeing after hours is you're seeing this rally. Now, I had this pegged as the next one that was going to have problems. I could be wrong here. This continues to push. I'm not going to go out there and buy any more regionals. I have a lot of interest in the regional space right now, and I'm not going to go out there and buy another one. But watch this tomorrow, because this could move. This could get people into this. Now, I said one more, but I'm going to do 2 more because I want you to get this. I've been preaching about this stock for probably since about back here, since about March, for those that have been watching these in the commentary. And I do get your comments and I do get your emails, and I appreciate how this has helped you. And I do respond to every comment and every email. It's just a one-man show, so you're going to have to bear with me. But you look at where we've been, you look at the gap, you look at from when they bought assets, and that's exactly what I said. When you buy assets, this is what happens. Tonight, you're coming out, especially when they're FDIC insured, and you're buying them at a discount. They came out tonight, they're doing a secondary, 40 million shares. Why do you think they need 40 million shares? What do you think they're going to do with that money? They're going to go out there and buy more assets. Okay, they're not going to buy a company, I don't think. They're going to buy more assets, and they want to raise capital to do it. Okay, so there's probably another bank out there that's having a problem, and they don't want JP Morgan to buy more assets, right? So maybe there's a bank out there that says that, they're not going to be around in 12 months if things stay the way they are. Maybe if there was a bank that said that, like, cough, cough, PACW, and they're trying to set this up ahead of time, might be something to think about, right? Maybe that's what's happening here. Maybe we should pay attention to this. I'm long this. I'm going to continue to stay long this. I would suggest that after this deal prices, you're going to see huge oversubscription for this demand. And I'm going to tell you why you're going to see huge demand for this. FCNCA. And I said I was going to show you one more. I'm going to show you two. I'm going to tell you why I'm showing you this. David Einhorn, who's one of the largest investment value managers out there, took 2 large stakes in new positions in the past quarter. One was FCNCA and the other was NYCB. So do you think that maybe they already know that they have a buyer for the NYCB? Because Einhorn manages legitimately billions. The majority of it now is his own money, but the purpose being, they have buyers out there. So a lot to watch tomorrow, guys. Have a good evening. Comment below. Specifically comment about the beginning with the pointer. I'm not sure which way to go with it. I think that one pointer kind of gets in the way. I do appreciate your comments. It helps me. Also, let me know what names you're watching tomorrow. I get a lot of great ideas, especially in the pre-market. I get a lot of great ideas from you guys. This OMH was just an absolute home run the other day. So I appreciate it, and I appreciate your input. Have a good evening.